Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Hey, welcome everyone. Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. Question number one from Leonard. He says, hey, we're going to purchase a second home once all of our kids are out of college. So that's about 7 years from now. So how should we be allocating our investments for this? All right, Leonard, 7 years from now. Good news is you've got your goals pretty well fine-tuned. You know what you're doing. I'm glad to hear that, because the first step is deciding, hey, what should your asset allocation be? Is understanding what the money's for, right? And you know what it's for. You're gonna set this pool of money aside from your retirement funds that's for a second home. So generally speaking, I would say you could have anywhere between 70% bonds and fixed income investments and 30% stocks, all the way to the inverse of that, 70% stocks and 30% bond and fixed income investments. So how do you determine where you are in that spectrum? First of all, it's how close you are to that goal, right? Do you need modest gains to get there, or do you need heroic gains to get there? Second of all, if something goes wrong, are you willing to postpone that goal? Is it the end of the world if you buy the house in 10 years instead of 7? So your risk tolerance is also a key factor to consider here. How comfortable are you seeing fluctuations in your portfolio value? Some people lose sleep when they see their investments drop 15%, while others can handle that volatility without much stress. This self-awareness is really important when crafting your allocation strategy. If the answer is yes, we've got a lot of the money saved, or yes, we feel like we wouldn't want to postpone the goal, then you probably want to go more fixed income than equity. But if you feel like, hey, we've got to make some gains on this, or we feel like, hey, we have to be willing to postpone it if we don't hit the goal because the markets don't cooperate, well, then maybe you want to be more equity-based. Now, you're probably thinking, okay, that's great, but I'm afraid to be more equity-based now in this time of uncertainty. Well, if it's money you don't have in the markets right now, you can always dollar cost average in, right? You can put together a plan over maybe 12, 18, even 24 months, where you gradually channel the money into stocks, into the market. I mean, right now, you get your money markets, they're paying 4% or so, maybe a little bit more. You can get some short-term CDs that are doing that. And really don't forget about laddering those CDs or bonds to create that kind of, proper, thorough maturity schedule, right? This can help you capture higher rates while maintaining some liquidity along the way. So you might consider putting some money into 1 year, 3 year, 5 year instruments, depending on when you'll need the funds. So you can actually be earning some interest while that, on that pool of money, while it's sitting there, and gradually every month a little bit, by bits and pieces, adding in, getting funneled into the market. Right, so those are some ideas, and I hope that helps you. And hey, I hope you enjoy that vacation home. That sounds like an exciting goal. Well, awesome question. If you would like to send in your question, you can do so. You can email it to poollocke@poollocke.com. We'll move on to our second question today. And this email comes from Janet. She says, if I invest in things for income, doesn't that increase my risk? Ironically, no. The opposite's actually true. And let's think about it. You have the growth of your money, and that comes from two different pieces. It's the income component plus the capital appreciation component. So let's say you're going to average 8% return, just to throw a number out there. Well, if you get 4% from the income, That's your known return. The income component is a known return, just like rental income, right? As long as the tenants are there, you know, hey, every month I'm going to get that rental check, right? Well, if you have a bond, that income component has to get paid. The interest has to get paid. Same with the preferreds, right? Preferred stocks, right? Even if you have a common stock, now that doesn't have to get paid, but companies that have common stocks typically don't like to decrease the income component. So this consistency is what makes income investing particularly attractive for retirees or those approaching retirement. Think about it. You know, when your paycheck stops, you need something reliable to replace it, right? Income investments provide that predictability in an otherwise unpredictable market environment. So that 4% from the income is that known component. What does that mean? That means if you're trying to get 8% total growth and you have 4% from the known, you only need to get 4% in capital appreciation on average. You only need the investments to go up by 4% a year. And because you're relying less on the capital appreciation, that means you have less volatility. Your risk actually goes down. Think about it. You know, the technology stocks, right? They have led the S&P 500 over the last 2+ years. They're the most volatile. But dividend stocks, over that period, the same period of time, haven't done quite as well because most technology stocks don't pay a dividend, right? They're trying to get it all from capital appreciation, not from the known return, right? They're trying to get it from the unknown return, the capital appreciation, right? Now, this isn't to say that, you should avoid growth completely. Diversification still matters, but understanding the role that income plays in reducing overall portfolio volatility is crucial, especially as you get closer to needing those dollars for your lifestyle expenses, right? However, when, things, turned at the beginning of the year and the S&P 500 was down at one point, 20% in value, most dividend stocks might have been down maybe about 5%, right? Because again, that known return, the dividend keeps getting paid out, and you can count on it. So therefore, because it's relying less on the capital appreciation to get a desired total growth rate, like that 8%, that means that when things go awry, there's less downside potential also. Now remember, when you're receiving income from your investments, you're not forced to sell assets at depressed prices during market downturns to generate cash for your living expenses. So this is a huge advantage that many investors overlook until they're actually in retirement and facing a declining market. So ironically, the opposite is true. More income, a higher I component, means less overall volatility. Awesome questions today. If you would like to send in your question, you can do so. You can email them to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I am James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.